I've been on a mission to try to get reforms to the Bank of England. I've been trying to stop the Bank of England printing money. And to do that, I wrote a paper about it. And then I made a documentary film called Ex Nihilo, The Truth About Money. Whenever a bank makes a loan, it literally creates new money. China's money supply is now double what the US money supply is. The US money supply is $21 trillion, and the Chinese money supply is $42 trillion.
In the United States, we get information from an entity called the Bureau of Labor Statistics, the BLS. I prefer to remove the L from that three-letter acronym and call it the BS, because they're not telling us what the real levels of inflation truly are. They're masking it. A trillion seconds ago was 31,688 years ago. So these numbers are spiraling out of control.
It's almost certain that most of the debt is going to be inflated away. And that's what people have to prepare for.
Well, what we're talking about here is effectively, ultimately down the line, is that labor, if you combine it with robotics, labor becomes free. Certainly already, labor is becoming cheaper as AI creates huge efficiencies to productivity in the short term. Hi, Andy. How you doing?
Jason, good to be back with you, my man. I'm well, thank you. How are you?
I'm great. Yeah, I had a nice long weekend with the missus. And
look good. You are handsome as hell, I got to tell you. You are one handsome looking dude.
I'm just trying to keep up with you. Come on.
No, it's the other way around, brother.
So yeah, that was really great. But wow, we've got a really fantastic day today. It's like our ninth podcast we've done. So we nearly got our top 10 under our belt. I was just saying to Andy before the show, most people when they set up a podcast get themselves really organized. They record at least 10 podcasts before, which are evergreen, so they don't have to be under too much pressure. We're like, let's just go for it. When are we going to do one? Tuesday, and that was it.
I like that. No, I like that. It's more authentic that way. I really do, and I think as the world gets crazier, our podcast will get better. So yeah, there is no better way to learn than baptism by fire. So hey, it's worked out so far.
And we love you, the audience, and we love seeing your comments, and we love seeing your support. You're really driving us. You're keeping us alive here with this. So we feed off your love. So please, lots of comments today. Please subscribe if you haven't done so already. It's really important for the algorithm. That's the thing that decides whether or not our videos get shown in people's feeds or not. So please do that. But listen, today I'm super excited to introduce Geoff Blanning. Geoff was the former investment manager and member of the group management committee at Schroders PLC. He co-produced Ex Nihilo, The Truth About Money, which is a documentary that dives into the flaws and issues with our current monetary system. And it features a range of thought leaders from all over the world. He wrote a paper called Put the Tools Away Now, Please, which was a kind of call to reform, a call to action of reform of the Bank of England, the central bank. And today, I think there's been some news about that or something similar. But I do say the documentary produced, Ex Nihilo, The Truth About Money, is available on YouTube. We'll put the description down below. Yes, I'm very pleased to have Geoff on the podcast.
I'm honored to be here, Jason and Andy. Thanks very much.
So we've known each other a little while now, haven't we?
We have.
And you've been a great supporter of what we're doing at Glint. So again, just take the opportunity in front of the world to thank you for that. You've been an amazing support, and it's been great to have you on our side and to get your advice from time to time. So thank you.
Well, Glint is what we need, is what the world needs, what savers need.
Thank you. So Geoff, please tell us a bit more about your background. It'd be great to hear it from you.
Are you enjoying the show? A quick reminder then to hit the subscribe button so you can be kept up to date about future episodes. Now, back to the show.
Thanks, Jason. Thanks for having me on the show. It's an honor. I was an investment manager for 35 years. I invested all around the world in bonds and currencies, and in the last 15 or 20 years in commodities. And since I retired a few years ago, I've been on a mission to try to get reforms to the Bank of England. I've been trying to stop the Bank of England printing money. And to do that, I wrote a paper about it. And then I made a documentary film called Ex Nihilo, The Truth About Money. which urges our politicians to restrict the power of the Bank of England to print money.
Thanks for coming on the show today, Geoff. Really appreciate it. So let's just get straight into it. So it's interesting that we're doing this podcast today of all days, because today in the Financial Times, there was an article saying it's now time is right for our Chancellor to reform the Bank of England, but maybe not in the same way that you envisaged with your paper. Is that right?
Absolutely not. And I would say it's typical of the times when all we see is when we're talking about central banks, we get people asking for it to be made easier for them to provide so-called stimulus, which basically means easier monetary policy, either cutting interest rates or printing more money, quantitative easing. And this is the problem. This is what we've seen in the last 10, 20, 30 years. We've seen central banks just allow the money supply to grow and grow much too fast for a low inflationary future. And that's why I started by writing a paper about it. I wrote a history of quantitative easing at the Bank of England called Put the Tools Away Now, Please. And then I decided we need to make a film about it to try to show people what's been happening, because most people don't understand what's happening to the money supply, how it's grown so fast and keeps growing, and then to suggest what we can do about it in terms of a few reforms in order to stop, again, I say a high inflationary future. We've had a few years just after COVID when we had inflation jump up to 10 or even nearly 15% in the UK. But that's just a sample of what I think of what we might get in the future if we carry on with the policies that we have.
Yeah, I mean, that film was just pretty amazing what you went through. I know it took you a long time. You've got some great people on there from all over the world. And you've got some great footage as well of people, in the street where you go to people and you ask them, how do you think money is made? By the way, can you just explain what an ex nihilo means?
Ex nihilo means out of thin air. And we gave it that title because that's where money comes from. Money is created in two different ways. And most people don't understand this. Even most economists, people who work in the finance sector, and certainly, obviously, most people in the street, it's very hard to understand. Money is created in two different ways. The first way is that when a bank makes a loan, every time a bank makes a loan, it's not actually lending money that someone else has deposited. It simply creates a new deposit in the person's bank account they're lending the money to. So whenever a bank makes a loan, it literally creates new money. And the second way the money is created is by central banks printing it. And they call it quantitative easing. When a central bank buys, typically they buy bonds, government bonds in the open market, and they call it quantitative easing. They're literally creating new money on their computers with a few taps on the keyboard, and new money is created. And the history of the last 20, 25 years is really in two parts. I would say pre the global financial crisis up to about 2008, commercial banks created enormous quantities of money, and the central banks allowed that to happen. They didn't stop it happening. They had interest rates which were too low, and they let the banks do that. And obviously that ended badly with the global financial crisis. And since 2008, most of the money that's been created, certainly in the UK, was not by commercial banks. It was by the Bank of England printing it. And the Bank of England did that because they thought that the commercial banks weren't going to create enough money. But the rate of growth of the money supply has been pretty similar throughout this period. It was typically 7 to 10% per annum in the UK and the US pre-2008. And then since then, it's been about 7% per annum in the US, and I've been somewhat less than that in the UK. In countries, other important countries such as China, which people got to realize how important China is to the world now in terms of the money supply. China's money supply is now double what the US money supply is. The US money supply is $21 trillion, and the Chinese money supply is $42 trillion. And China's
Wow.
money supply has been growing at 10% per annum for the past 10 years and hardly missed a beat. So China's money supply has grown 150% in the last 10 years. The US money supply has grown at 7% a year and that has therefore doubled. But China's money supply has grown 150%. So all of this, when you're analyzing what's happening in the world in terms of inflation, trying to forecast inflation, what's going to happen to commodity prices, what's going to happen to the gold price, and so on, we have to look at it on a global basis. And all the central banks are the same. Some are just more extreme than others. Some are just creating more money than others.
I guess, Geoff, one of the questions after hearing what you said there, you're talking about a 7% per annum increase in the money supply. And of course, in the United States over the last several years, we've created more money than in the history of the country preceding it over just the last 4 or 5 years. And we're told that we have a positive real yield. In other words, we're told that, at least in the United States, that inflation is under the interest rate that you're able to receive on short-term treasuries. Now, in the United States, we get information from an entity called the Bureau of Labor Statistics, the BLS. I prefer to remove the L from that 3-letter acronym and call it the BS, because they're not telling us what the real levels of inflation truly are. They're masking it, and I'm assuming they do something similar in the UK. My question to you really is, and this is an important one because so few people, as you mentioned, really get what's happening. So few people understand that you're going backwards even when you think you're going forwards. This is one of the reasons that I look at gold as an asset that is so misunderstood, as it is appreciated by 9.9% per year compounding on average for the past 25 years since 2000. And yet it's underappreciated and it's underloved. People would rather own treasuries where you're going backwards when we factor in the real value of money next to inflation. My question to you in a nutshell is, how do you get your information? Where do you go about discovering what money creation truly is? And how can, I know that's the premise of the movie or a large portion of your documentary, but how do we get that information out to the public, and how can we find that information without dedicating copious amounts of time digging and searching? Because in the US, when I started here in this industry, Geoff, 35 years ago, there used to be something called M3 money supply, which was the broadest measure of the money supply, which they stopped producing, citing it as archaic. Therefore, none of us really know how much money they are creating. What do you do, and how did you go about researching to find out the real amount of money creation? Because really, in the end, for us savers, it doesn't get much more important than that.
You're absolutely right. It's difficult for the average person to find out the information. First of all, you have to figure out what the different measures of money supply actually mean. And it's not the same from country to country. And they do change over time as well. But basically, the central banks on their websites, they do have that information. So you can figure out what the total quantity of deposits, bank deposits is in any country. That's, for me, that's the most important thing, because that's the money that people could then take out and go and spend, in theory. In the UK, the figure that we use is called M4. In the US, it's M2. But they basically measure the same thing. And the money and the numbers are on the central bank websites. But it doesn't really matter because what the history is that the money supply has increased at a 7% annual rate for decades. So it's not just the last 10 years, it's the last 20 years, 30 years, 40 years. You can go back, and typically 7% annual rate of increase means a doubling every 10 years.
10.2 years, yeah.
And that is what has happened in the US, and that is what has happened globally. As I said, in China, actually, it's been somewhat faster than that in the last 10 years. In the UK, it's been somewhat lower than that. But basically, on average, you can assume the way central banks are run today, the money supply is going to grow at typically 7% per annum. And
it's funny, Geoff? I ask people all the time, do you know what the rule of 70 seconds is? And most people say, no, what's that? Which what you're speaking of. You take the interest rate, divide it into 72, and it tells you how long before your principal doubles. or in this case, is cut in half the value of the currency. And things that should be so front and center, so important, like the laws of interest, right? The rule of 70 seconds. In 10.2 years at 7% inflation or 7% increase in the money supply, your currency is cut in half, the value of it. So not only do they mask the ability to really easily find this information, most people don't have any idea about maybe the most important thing that you can learn as a young person, and that is the laws of compounding, how it can work for you, or in this case, against you, and to be able to protect yourself from this insidious hidden tax of inflation that is cutting, in essence, the value of the pound in half every 10 years. So you have to be able to prepare and get out of the way of that. And that's one of the things that I think is so very important, what you're trying to teach people. And in fact, I did an interview with G. Edward Griffin the other day, who speaks a similar message to you with The Creature from Jekyll Island, talking about the mismanagement of the Federal Reserve. But these are things that people need to know. And I asked him, I said, what would be the most important thing that you would teach a young student in class and nowadays, and what would you add to the curriculum? And one of the things he said is to understand the laws of compounding, to understand the laws of interest. And this is a prime example. So in essence, what you're saying is that if you don't understand this, if you don't have the information, you have to, in essence, do better than a 7% return to not go backwards. And that's something I think should be surprising to most people watching this show. Not surprising perhaps to me or to Jason or to you, because we immerse ourselves in this stuff. But to most people watching, I think they'd be surprised to hear that.
They would. And what they also have to know is the link between money supply growth and inflation. Because central bankers today and most economists, mainstream economists, will tell you that there's not much of a link. In fact, Jay Powell, the chairman of the Federal Reserve, said it a few years ago. He said there used to be a link between money supply and inflation, but it doesn't really work anymore. This is nonsense, right? You go back through history, the clearest and perhaps one of the most simplest and clearest facts, if you like, in economics is that inflation matches the money supply over long periods of time. Maybe not over 2 or 3 years or 5 years, but over decades. The rate of inflation in a country will typically match what the money supply growth has been. And the thing is, in the last 10 years, just taken as an example, in the US, we've had about 30% inflation in 10 years, but the money supply has grown by 100%. So what's happened to all that money? Right. And I think part of it is that the inflation actually is underreported. As you said, the BLS is not recording it properly. So probably real inflation.
Did you say BS or BLS?
I'm actually lobbying to call it the BS.
Yeah. So
and the
CPI
from the BS.
Clearly, consumer price inflation is under-recorded, but also the rest of the money is still out there. And it will come into consumer price inflation in the future. And this is what I worry about so much, because where has that money gone? Actually, it's gone into financial markets, because when they print money, the Fed, the Bank of England, they buy government bonds in the US treasuries, and the money goes straight into financial markets, and it gooses up the financial markets, the bond markets, the stock markets, and so on. But eventually, that money will find its way into consumer goods prices. Sooner or later, it will come. It will affect the oil price. It will affect the price of copper. It will affect the price of food. And those prices will jump. And that's what people have to worry about. So, yes.
That's Jason's favorite topic. That's the Cantillon effect in real world, where the people closest to the money benefit the most disproportionately, where they can take that money, borrow it at next to nothing, and plug it into financial assets, making their portfolios go parabolic. And by the time it trickles on down to the public, could be 2-3 years later, well, you see much higher consumer prices in things like food and energy and insurance and housing and tuition and all of the things that cost us all so much money. And Jason and I talked about the Cantillon effect a couple episodes ago, but here it is for all of you listening. Here it is in real life. And that's exactly the point that Jason was making a few weeks ago. I'm glad you brought that up.
Exactly.
Yeah, I think even the chancellors of the exchequer who run the central banks have been spotted in the halls of power reading books entitled "How Money is Made." and Geoff, we've talked about this. It's not even taught in economics in universities, is it?
It's not. It's not at all. You open a typical textbook on economics, and you won't find anything which describes how money is created.
And so, apart from the fact it's driving this massive wealth gap and inequality, why do you think that the central banks, is it incompetence that they fail to be able to understand this? Is it willful and that it somehow benefits them? What do you think is going on?
I don't think it's willful. I don't think they do understand it, but they don't want to do anything about it. I think they don't understand it. I think that mostly it comes down to the way economics is taught and today, and what is accepted as correct in economics. And most people accept Keynesian economics. And in Keynesian economics today, that always has been the case, money doesn't really come into it. There's a Keynesian equation of GMP, of growth, what is growth made up of, and money is not in it. You could double the money supply and it won't affect anybody who follows Keynesian economics. It won't affect their economic forecasts. So all of these models that they have, which they spend years developing of the economy, money isn't in it. There's no room in it for money. So I think they need to. They will wake up at some point. At some point, they will understand that money has to be in it, and economics will make progress.
Is that because at the time, I don't know the history here, but when Keynes was writing this stuff up and talking about it, was that because money was stable? Was it backed by gold? And so it didn't come into his writing, that he didn't envisage a world where money could be printed to the extent it's printed now, I wonder?
I think that's probably the right answer, to be honest. The money supply was obviously much more stable because money was backed by gold, and the gold supply only increases by 1 or 2% a year. So you couldn't have it right now where you can have the money supply increase by 15% or 20% a year, as we saw during COVID. It wasn't even contemplated.
One of the things that comes to people's mind is that there's $35 trillion worth of debt. And just for the record, Andy, can you just give your explanation so people can understand what the size of a trillion is, to put it into perspective?
Yeah, I love that. I'm glad you brought that up too, Jason. That's my favorite. Trillion seconds ago was 31,688 years ago. We all make $1 million in a lifetime working. Whether or not we save it is debatable. But the word million doesn't have the same allure or prestige that it once did. Certainly, and that has to do with the value of money being worth less. But it rhymes with trillion, and one would think that must not be that big of a deal if they're creating $1 trillion in debt every 3 months, right? 100,000 in debt every second. 1, 2, 3, 4, and keep on going. A trillion seconds ago was 31,688 years ago. So these numbers are spiraling out of control. These numbers are becoming too big to be managed. Absolutely.
But of course, the policy they've got, Geoff, the policy that central banks have, of course, benefits that debt in a way, doesn't it? Because effectively over time, it makes it worthless. Where do you think that the policy is leading us to? What do you think about that huge amount of debt, which, as we know, the main proponents of it are people's pensions, Medicare, defense, and even the interest payments on this debt. Where's the policy going? Where's that debt going? What does it mean you talked about how money gets into the economy. Is it just going to inflate the markets again? And what does it do to inflation?
Yeah, I mean, as the public debt gets bigger and bigger, then the interest cost every year gets bigger. And obviously, especially if interest rates go up, interest rates went up recently with central bank tightening, the interest expense goes up very fast. So what it means is the pressure on the central bank to not raise interest rates, and in fact to cut interest rates, grows. And that will only get more intense as we go on, because it doesn't, at the moment, there doesn't seem to be any constraint on the government in terms of its deficit spending and borrowing. So the debt is just growing and growing. It's the same in the US, the UK, in Europe, in Japan. And until the bond markets really revolt and we see bond yields go up rapidly, which will happen at some point, we'll see a crash of the bond markets, then there will be a pressure for the public sector to stop increasing the debt. But there'll be massive pressure on the central bank to keep rates low, and obviously to print money to buy up that debt, which, as we know, that's been going on, particularly in Japan.
So it seems to me that this is the crux of the whole problem, is that the countries that you mentioned, the G7, have ruled the roost for a very long time. And it's now gotten to the point where we are supposed to believe that the United Kingdom is one of the largest purchasers of the U.S. Treasury debt. So a broke country is buying the debt of an even more broke country, instead of the countries that used to be financing our debt, who are now selling that debt and letting it roll over and not repurchasing it, letting it just roll off their balance sheets rather. And they're buying gold, which has doubled the performance of the 10-year Treasury with no counterparty risk. My question to you, as someone who is a student of central banks, is, have we reached that moment where the privilege of being the Western rule of law, being the Western system, the Western entity that has ruled the world for 5 centuries financially, are we getting to the point where the rest of the world says, piss off, I don't want your debt anymore, and you're continuing to choose inflation over austerity the way that all politicians have done forever, that we are moving to a different system, maybe one backed by gold, as Zoltan Pozsar calls it, Bretton Woods 3? How close are we to that moment where this hubris, this privilege that we have taken for granted, it's losing your thumb in an accident? God forbid you never realize how important something is until it's gone. Are we close to losing our thumb, us being the West, the UK and the United States, and the G7 at large?
I think there's a lot of truth in that. I don't think it's not just black and white like that. It's very clear as that Eastern central banks have been buying gold like it's going out of fashion, particularly in the last 12, 18 months, and that seems to be accelerating. There's a big story came out recently about how Saudi Arabian central bank is secretly buying gold, and how the Indian central bank is buying gold. We know Russia is stacking gold, China is. But remember what I said about the Chinese money supply. So China's money supply is growing faster than anybody else's, and that's been going on for a decade at least. So it's not like they are an example of great policy and, I'm trying to think of the right word, of good behavior. They are doing exactly what we're doing as well. So there is no example of a central bank which is really behaving responsibly. It's just that some people realize that actually gold is something which is clearly going to go up in value significantly in this environment, because there's just no doubt about it that as the money supply grows and grows, gold is the one thing which is going to protect their purchasing power.
But I suppose if you've got this exorbitant privilege of being a central bank, and it's not backed by anything, since certainly with the US since 1971, and you're able to print as much as you want, and you see the end in sight, whether you're China, whether you see the US, presumably one policy is to spend it as quickly as possible before the world wakes up. It's a bit of a race to see who can buy as many assets as possible. And you've seen, of course, with the China, you've got the belt and braces, you've got the Silk Road being built, and they're really going out there to try and to expand their influence as far and wide as possible, to buy as many assets as they can. Do you think there's maybe something in that?
Absolutely. There's a race for resources, because resources in the ground, oil, obviously gold, but all kinds of metals, precious metals, and metals that are going to be used for the new technology, for electric cars and so on. There's a scramble for real resources going on around the world as we speak. And the Eastern countries are certainly well ahead of the game in terms of their understanding that is going to get more and more worse. That's going to get worse and worse. There's going to be more and more competition for those resources.
Which kind of brings me on to one of my favorite subjects, which is artificial intelligence. It's a phenomenal evolution of technology that we're seeing unfolding right between our eyes. And I don't think we've ever experienced a rate of technological change as great as we are seeing with AI. It's much faster than what I experienced when we went through the evolution of the internet and the dot-com boom. This is something else on a totally different level. With artificial intelligence, of course, it's doubling its power every few weeks, never mind months or years. And I'm sure that we're not very far away. Within a series, you can count it in months or a few years, where we get some exceptionally advanced artificial intelligence. Some people are talking about general artificial intelligence, something that can effectively behave and move and work on its own without specific instruction on a step-by-step basis. What does this really mean for us? Well, what we're talking about here is effectively, ultimately down the line, is that labor, if you combine it with robotics, labor becomes free. Certainly already labor is becoming cheaper as AI creates huge efficiencies to productivity in the short term. But actually, if you have productivity increasing, you've discussed before, Geoff, haven't you? This is deflationary. And if labor trends towards zero in terms of cost, if energy, which is required, huge amounts of energy. I heard the other day that Microsoft are buying all the energy from, is it Long Island? Was there some kind of a nuclear facility that they shut down some time ago? And they're building a nuclear power station, and Microsoft are buying all the energy from it for the next few decades, because they're going to need their own nuclear power station to power this AI. But effectively, if labor is free, if energy is free, again, I'm not an economist, but is the third thing in the equation of economics resources? So if resources is the only thing left, is that what the race is for?
The race is certainly for resources, because for energy is the most important resource, and our demand for energy is unlimited. It always is. We use whatever we can get our hands on at a reasonable price. As you say, AI is using enormous amounts of energy. There's going to be more and more demand for fossil fuels, even though people want to get off them. But it's to me, it's certain that the price of oil and gas is going to go higher, as is the price of any metals that are going to be used in electrification. But AI is interesting because that means higher productivity. You're talking about higher productivity. And that's good, right? If we have this huge debts, then in theory, if we grew faster, we might be able to pay down those debts. But the reality is that the debts are growing so fast. I think even with AI, it's pretty optimistic to think that we can raise our growth rate enough to get us to grow our way out of our debt burden. It's almost certain that most of the debt is going to be inflated away. And that's what people have to prepare for.
Would you then say that the Bank of England should mirror the Fed? See, I think the Fed gave up on inflation, and they're pivoting and lowering rates because of their dual mandate of full employment. And I'm not mistaken, the Bank of England doesn't do that. The Bank of England focuses more narrowly just on inflation. But if we're moving into a period of time where full employment or lack thereof due to something external force like AI would take over, when you talk about timing to reform the Bank of England, would you think that would be something that they ought to focus on as well as employment, the way the Federal Reserve does?
You're 100% correct. The Bank of England's mandate is simply on inflation, whereas the Fed has a dual mandate, inflation and employment, right? So that's actually what the article in the FT talks about today. So it says the time is right for Reeves to reform the Bank of England. One of the things he says is that the Bank of England should move towards a dual mandate. I don't agree with that. Obviously, I think the Bank of England, the central bank, should focus on protecting the purchasing power of the currency, so that from one generation to the next, that the pound will be worth the same, or in the US, the dollar will be worth $1. It'll buy the same amount of goods now and in 5 years, in 10 years, in 20 years' time. I think that's what we need, and that's what we don't have at the moment. We don't know what the dollar is going to be worth in 10 years' time, except that we know it's going to be a lot less.
Doesn't that just scream gold backing? Because if you take a look at an ounce of gold from going all the way back, you don't see that you're becoming wealthy by owning it. What is that? It is wealth, and that it maintains purchasing power, as the currency, to your point, is being cut in half every 10.2 years. So doesn't that really just simply say, and all the people out there who say gold backing doesn't work, for 180 years, we had gold backing, and the greatest prosperity the world has ever seen with zero inflation. It's the central bankers who have us convinced that a gold backing doesn't work. But it appears to me that is the direction we are going. Again, looking at the unit settlement currency that has been evidently has been agreed upon in principle by Dilma Rousseff, the former president of Brazil and the head of the BRICS New Development Bank, along with Sergei Glaziev and Putin at the meeting in Russia a few weeks ago. They agreed to it in principle. They're having a meeting here this week or next week in China to ratify it with the intention of perhaps rolling it out in October. But it is a marriage of blockchain technology and gold for a settlement currency. And that gold does just what you're saying, because that same dollar that you have does not purchase what it used to at all. And it's getting worse and worse and worse. And if you realize that dollar or that pound is worth 50 cents, or I'm not sure, is it pence, whatever it is, it's worth half of its value in 10 years. Doesn't that just scream that the main thing that's been missing all along is pulling gold out of the system and allowing central bankers to create money at their whim?
100% right. 10 years ago, the gold price was $1,300, right? It's now double that, $2,600, and the money supply in the US has increased by 100%.
There you go. That's exactly. If that doesn't explain it, I don't know what does, man. Jeff, that's perfect. Gold's doubled as the currency's been cut in half. What more do you need to know? And that you go back through all of history. You look at Roosevelt here in 33, that ounce of gold right there, which was a $20 gold piece, would have bought you a suit and a tie and an overcoat. That $20, that the face value wouldn't even buy you a tie today 100 years ago, but that $20 back then bought you all that stuff. But the ounce of gold today at $2,600 buy you a hell of a nice suit and tie and overcoat. It's exact same thing that you go all the way back 100 years or 10 years, and it's brilliant. And we can bring it all full circle. This is the whole reason to own gold, not to become wealthy, but because it is wealth in a form that retains your purchasing power. And I don't think that it's ever, you could drop the mic on that one right there, simply because that 10-year analogy is spot on perfect.
Yeah, and I think it is inevitable that we will go back to a gold-backed currency. I think it's inevitable. I think it has to be, because the current system is not working. And we had it, as you say, we had a gold-backed currency for years, decades, and it worked very well. And I think it's inevitable. It's the only way we're going to have a currency which maintains its value. It's got to be backed by something real, and gold is the obvious thing and the thing that's worked throughout history.
Yeah, it's interesting though, the perception people have since we came off the gold standard. I find it fascinating how perceptions can change so quickly. And I think a lot of it's due to the fact that we actually don't live that long, and we get old and we stop working, and then a whole new generation of people come in, and they haven't necessarily had the transfer of knowledge. And so they certainly don't remember when money was backed by gold. And so their recency bias makes them quiz, why on earth do you even want to get into gold? This goes as far as the regulators. I know I was speaking to somebody in insurance just this morning, and they said that it wasn't that long ago, they tried to they convinced their CEO, the chief risk officer, convinced the CEO, convinced the board that they should be buying some gold. They went off to speak to the regulator, and the regulator was like, oh, this is risky. The gold price changes and stuff. You're gonna have to back that with other funds. I'm like, hang on a second. Gold's owned by all the central banks. Now, in the end, they didn't do it because of the impediments the regulator put on them, which I'm guessing, again, we mustn't mix up incompetence with, say, conspiracy. They weren't allowed to do that. Maybe the fact that now gold is being declared by Basel III as a tier 1 asset might start to change that. We've already seen, as we've discussed on this podcast now, US state treasuries starting to look to buy gold, and that dam could be bursting. That could be the thing that bursts it, as effectively these governments validate the use of gold in people's treasuries.
I like your reasoning very much there, Jason, and I think it's spot on, as a matter of fact.
So, Geoff, just to finish off, really, what do you think is going to happen next? And what do you think individuals can do to protect their family wealth and financial security?
I think we're in a gold bull market. And individuals, because of the nature of the financial system, at any time, individuals should hold a decent percentage of their wealth in precious metals. But right now, in particular, because the gold price is going up and it appears to be in a major and aggressive bull market, then individuals should hold more than normal. I would, a typical financial advisor might say you should hold 5% of your wealth in precious metals. I've always said you should have at least 25%. And right now, any amount is fine because the price of gold appears to be, as in a major bull market where it could go much higher in time. So the first thing people can do is they must have precious metals exposure. And after that, it's very difficult because, as we all know, it's very difficult to get good financial advice. It's very difficult to time the markets. The best thing people can do is to spread their assets around in different things, invest in things that they have personal experience of, a business that they know about or that a family member knows about. But otherwise, just be very careful and hold some assets in some different strategies, but not put everything in the stock market. I think my industry that I worked in for 35 years, the investment management industry, has been quite poor at advising people, because you quite often see people they've spent most of their working life building up a business or saving, and they have a big pot of money, they sell the business, and then they put it all into the stock market or something like that. They put it all into one asset or another, and that's irresponsible. It's very hard to make money in financial markets, even for professionals. You need to be very careful, but obviously some exposure to a variety of different assets is sensible, is prudent, particularly if it's a type of asset that you know about, a business you know about. If you worked in the restaurant business your whole life, then you probably have an insight investing in stocks or in private businesses in that area. That's the kind of thing. Otherwise, keep a decent percentage in precious metals, and particularly now, maybe increase that by 30 or 50%.
Thank you, Geoff. It's been great talking to you. Before we finish, can you just give a little bit more color on Ex Nihilo, The Truth About Money? Just give us just why people should go and watch it, what they might expect to see.
Thanks, Jason. Yeah, it's a 1-hour documentary. It was actually released a year ago. It's on YouTube. You can find it very easily. It explains where money comes from. It explains how easily it is that money has been produced, created by central banks and by banks. It explains the problems that has caused in terms of the distortions in the economy and the build-up in inflationary pressure that's there. I call it the monetary overhang, which we have today clearly. And it talks about what we need to do to reform the system, to avoid the situation where we end up with 30, 40, 50% inflation. I won't say hyperinflation because that's very extreme, but clearly we're going to a situation, if we don't reform anything, of much higher inflation, and most people will suffer very badly in that economic environment, clearly, and that's something we really have to try and avoid. So I urge people to watch the film, and if they understand the messages, they like the messages, then pass it on, show it to other people, get other people to watch it, and write to your politicians about it and urge them to ask for discussion about reform of the central banks, because that's the only thing only way it's going to change.
Yeah, you heard it here, guys. You have the power. You can talk to your electorate. They're the ones. They need your votes to get back in power. So tell them this is on your mind. This is something you're worried about, and you want them to look into it. You want action now. So get in touch with your local legislator, your local representative, your local MP, and demand that they start asking questions, because that's something you need them to do. But Geoff, thank you very much. I really appreciate taking the time.
Fascinating. Thank you, Geoff.
Come talk to us. Yeah.
It's been a great pleasure. Thanks for having me on.
See you guys. And listen, just one last thing for everybody. If you like today, please comment, ask questions. We'll answer them at the next episode next week if we can. Put your comments in there and subscribe. But until next week, goodbye.